This morning you'll hear from four of us with some different perspectives on early stage fundraising. Just to introduce, who's along with us. Rick Brimacombe from Brimacombe and Associates is hiding over here. Rick is a former venture capitalist, a venture catalyst. He runs the Network Connect. He runs with Dick Summerstead. He has why am I now going to spit it out right over at the Minneapolis Club E events. Mentor to a lot of Cup participants and other entrepreneurs along the way. And the fun fact is, on 7/7/7, he and I together got to see Prince at the Macy's Auditorium with about 200 other people. So that was kind of a fun thing to do together. Reid Robinson, back over here from Group Capital. Reid has a great entrepreneurial background, working with Beta for many years, and a whole bunch of different things. When he was with Worrell, which is a group that designs medical device and other consumer-facing kinds of products. I think that was the first time that Reid and I met. I was mentoring another group, and we came on in there, and that's the first time I think that I saw him, and that's got to be back in 2007 or so, maybe.
Probably like 14.
2014. All right, so there you go. Can't keep track of where time is on the front. And then Angie Conley over here from Abilitech is going to be able to give a fine perspective on from the entrepreneur's perspective on fundraising. And we met when she was in the Minnesota Cup competition herself, and ended up presenting at at Angel Pollination, which is the angel investment group that I run. And so if you win the cup, you get to come and present at our event. And so thank you very much for joining us as well too this morning. So we'll go to the next slide, Emma. So we're going to have to call out moving slides along the way, folks, because I couldn't find my clicker. We can go to the next one. So you get stuck with me first for a little bit on what is the law that governs the ability to go out and do fundraising. Then you'll get to hear from the people who will actually help you get it done, which is not a bad thing. Oh, you can go back one slide. So the first thing that's important to understand is why are we even talking about laws that govern anything? And what we're governing is securities. And I think we're all familiar with things like stock from Walt Disney, or promissory notes or bonds. We can all understand that kind of concept. But next slide. Here's a worm farm, and here's some Bitcoin. And why does that look like anything to deal with the security? It doesn't make any sense. Next slide. Well, the way we analyze things that don't obviously appear to be securities is we look at the issue of whether we are investing money or something of value in a common enterprise with the expectation of profits to be derived solely or principally through the efforts of others. So going backwards one slide, Emma. Whoop, one slide forward. There we go.
Mind of its own.
It does have, yeah. Use this stuff over here.
Mm-hmm.
Cool. So in both these cases, early on, Bitcoin wasn't really thought of as a currency. It was more of an opportunity to put money on in and try to profit from other people's doing whatever they were doing with it. The worm farm was really all about saying, hey, let's all pool our money together and build worm farms, and we can make all kinds of money, selling them to fishermen. What happened in all these cases is that laws say, hey, if you're going to publicly sell something that is a security to the public, and you don't file paperwork with the U.S. Securities and Exchange Commission to be a public company, you're violating all kinds of laws. And so both these kinds of things got into trouble. A couple of slides up now. So I'm going to put this all in the perspective of course, the big headlines we've had and continue to kind of focus on a lot is private fundraising, and then of course this more newer thing is crowdfunding. And next slide, Emma. So crowdfunding is really nothing particularly new. It's an idea of saying, let's get money for a great idea from a bunch of people. Next slide. The American Red Cross is essentially that, right? That's raising money for the great idea of saving humanity from a whole bunch of people. So crowdfunding is nothing that's particularly new. Next slide. But we've gone into a generation now where we have things that are quite different in the world. So we have Indiegogo We have, as a way of being able to raise money. There's $975,000 that they raised from 8,886 different backers to build out and sell an aerial little camera. This is a local company, here in town called Air Selfie. Next slide. So why does Indiegogo exist? And you can do that without any filings with the SEC. And the reason is that while we are investing money in a common enterprise and expecting somebody else to do the work for us, we have no expectation of profits. All we want is the thing. We're looking for the thing. In that case, the camera or whatever it is that you happen to be backing as a thing. So this rewards-based crowdfunding is legal because we're not trying to share profits with anybody else. Next slide. So now the innovation, of course, is equity crowdfunding, where you actually have the ability to have a startup and some platform in between that lets investors actually invest for an investment to get a return. But now that implicates a variety of laws. Next slide. In the Jobs Act of 2012, there was the creation of this platform for national crowdfunding to be able to go out and raise money from all kinds of different people. And it took a number of years for regulations to come into effect that you can do it. And it's still, I think, fairly early on in its infancy. But there are a couple of things I want you to know. First off, you can raise up to $5 million now with national crowdfunding as of March of this year. It used to be only 1.07 million. It's bumped up a lot. Number two, next slide. If you're dealing with folks who are rich people, we call them accredited investors, and we'll talk a little bit about the importance of that concept in their profile in a few minutes. But if you're dealing with folks who are the poor people of the world, i.e., the crowd, then there is a limitation on how much money you can take from any one person. The bottom line of reading through this is at the bottom, you can take at least $2,200 from somebody, and at the top, you can't take more than $107,000. So it's a relatively modest range if you want a rich person of how much money you can invest into a project. Next thing. Third thing is that you can't just take the money straight forward when you're doing one of these big crowdfunding campaigns. You have to use either a traditional securities broker dealer, most of whom don't want to touch these little tiny kinds of deals, or you have to use what's called a funding portal, and that's something that was created as part of the Jobs Act. And so companies have to sell and communicate with investors through this portal. It's registered with the SEC and the brokerage industry's self-regulatory thing called FINRA, and it ranges for handling funds and providing information to investors, and it's really the place where investors find companies that are doing crowdfunding campaigns. Next slide. And the last thing is you don't get to do it just for free. You actually have to have some disclosure information. So there's something called a Form C, which has a variety of different kinds of information that you have to provide, including financial information. And so one of the expensive things of being a publicly traded company is having to go through the process of audited financial statements and everything. Well, if you're trying to raise under $107,000, you only need a tax return or your current unaudited financials. You actually have to go to the outside and have an accountant review your financials if you're getting up to $535,000. And if you want to go past that, then you have to have audited financial statements. So you'll see a lot of deals that kind of fit the category in here and down, just simply to avoid having to deal with audited financial statements. So next slide. So where is this going now in 2020? Well, there's been 1,000 different offerings last year during the course of the pandemic that actually successfully raised enough money to close a crowdfunding campaign. They raised in the aggregate $215 million. A lot of investors, a lot of people have started piling into investing into crowdfunding campaigns. But the dollar amounts are small, $275,000 or so on average. And the important thing about that is you're taking on a whole bunch of different investors that you don't know who they are and where they are and whether they're going to be calling you on the phone and bothering you all the time to say, what's happening with my company? What's happening with my company? To on average only raise $275,000. So I still have some issues about whether or not this is yet robust enough for the real thing you want to get done in today's world, but it's a great publicity campaign as well too. Next slide. So these portals also make a difference as well too. So it's hard to see on this slide, but WeFund or StartEdge and the Republic are the first three. They're really the ones that have the bulk of all the activity. There's about 65 registered portals nowadays. And if you think about it, a portal is a place where investors are going to find companies. So if they're a small portal, they're not going to attract a lot of eyeballs and therefore create a lot of opportunity to invest in your company. So you almost really are kind of forced to have to deal with the bigger players in the space if you want to get some traction in a sense. Next slide. So it's all great to talk about crowdfunding, but the action where money is really raised is in secret. Does anybody know who this character is? Yeah,
A couple of us.
yeah, a couple of us know. So this is Maxwell Smart. There was a old television show called Get Smart, and he was always sleuthing around and trying to bumble his way through solving crimes and things of the sort and save the world. And this is his old cell phone, which was in the shoe. So he's having a secret conversation. Well, that is what private fundraising is about, is a bit of a secret. Next slide. And the secret is, where do you find these folks called the accredited investors? And in a moment, you'll understand the importance of dealing with accredited investors. They're the folks that have a net worth of $1 million or more, excluding the value of their home, or that in the last 2 years, they had $200,000 of individual income or $300,000 joint with their spouse, and they expect to achieve those particular objectives in the current year. And if they do that, they fit a special place in the laws that govern fundraising. And we get that by going to the next slide, which is, so when we're raising money privately, we call it a private placement. It doesn't have anything to do with adoptions. It just has to do with money. And so there's a securities law rule that is really nice to work with, because if you deal with solely accredited investors to raise money, you're going to get any amount of money you want to raise from them. You can raise it from an unlimited number of those kinds of investors. If you want to raise money from the poor folks of the world in this private kind of, connecting to folks, then you can't raise it from more than 35 of them, but that's in a 90-day period. By the way, it used to be 35 in a 12-month period, and the SEC has shortened that time period recently in March as well too. The key thing is that the typical private placement is exactly that. You aren't going to publicly solicit for investors. You're not going to advertise on the internet. You're not going to go to events and scream, "Hey, we're raising money today." You're not going to go walk into restaurants and just and deal with any sort of folks. And you have a question.
Just a quick thing: the unlimited accredited investors, that is dependent upon your entity type, so not upon your entity type, your type of entity that you have.
No, it has. It is not. It's not as to the entity. I don't care whether you're a corporation, an LLC, whatever it is. It's the number of the number and type of investors is separate and distinct from whatever your entity is.
Doesn't an S corporation have a limitation?
Well, okay, so an S corporation is going to have a limitation of the type of investor because of tax law, not because of securities law. Yeah, they're going to have 75, investors that you can have in an S corporation, and we can talk a little. So an S corporation is there are different entities you can have your business in, and I wasn't going to quite go there unless there was a question, but there's corporations and there's limited liability companies, and they're the most common things, and there are reasons why we'd use one or the other. If you happen to pick a corporate form, there are two ways corporations can be taxed. One is they're taxed like Apple Computer and others. They bring in income and they pay taxes themselves. It's called a C corporation. And then there's something called an S corporation, which is they bring in money, but they don't pay taxes. The taxes are all paid by the owners pro rata based on their ownership percentage of the company. If it's an S corporation, the tax laws, and of course what that means is the advantage of an S corporation is you're only taxed once. So there's no taxation at the entity level. It's just the owners who pay the taxes. If you think about Apple Computer, for example, which is a C corporation, Apple pays taxes or tries to reduce as to the smallest amount that they pay of taxes. And then when they pay dividends out to owners, the owners have to pay taxes on those dividends at a second level. So an S corporation avoids that, but the quid pro quo is an S corporation can only have certain kinds of owners, and it's usually individuals, and it can only have up to 75 of them. So that is a tax issue, it's not a securities issue. From a securities law perspective, if you're dealing with the rich people of the world, you get to raise your money from as many of them as you want, and that's one of the great reasons to do so. The other thing is that if you're dealing with solely accredited investors, you're not required to have a full-blown document called a private placement memorandum. So if you're dealing with the poor people of the world, we really need to tell them everything about the company. And so you're required to have a document that's kind of expensive and time consuming to put together. And, you know, as nimble and quick entrepreneurs as you are, you would really prefer to use a little video, a little a PowerPoint presentation, some one-on-one Zoom meetings or in person, dear God, and to be able to raise your capital. And so in that context, if you're dealing with just the solely accredited investors, there's no mandated disclosure. We would still say that you would probably want to give investors a document that says, here's all the reasons why you shouldn't give us your money. This company is going to fail. We're just a startup. We're stupid people. Our technology doesn't work. We don't know if it ever will work. You may never make any money, but give us your money anyway. And now I can sleep at night on that perspective. So this risk factor disclosure is kind of your insurance policy as an entrepreneur, and it's still good to use even with the rich folks. So, and the nice thing about this all is that at most you end up with some sort of notice filing with the SEC. You don't have to do pay fees and all kinds of expensive things with the SEC to be able to get this kind of done. Next slide. So, of course, as I said, you can't publicly solicit for investors. It was all basically getting connected privately, networking quietly to meet prospective investors. But as part of that same act that created crowdfunding in 2012, there was also a provision that provided that you can now shout it out for any investors as long as you're looking for accredited investors only. So you can actually publicly solicit for accredited investors. But how does that work? Next slide. If you are dealing with investors and connecting with them privately, and they're going to invest, you know, they're going to sign a subscription agreement, and it's going to say, hey, I am a rich person and I qualify as an accredited investor. And you can take their word for it, unless, of course, you find them laying out on the street and truly believe that they're just penniless and they're just putting you on. But barring anything like that, you can accept what they say. In the case of publicly soliciting for investors, the assumption is you don't know who it is you're talking to. So you have to take reasonable steps to determine whether or not you're actually dealing with an accredited investor if you want to publicly solicit for them. Next slide. So if everybody knows your name, and I assume most people recognize these faces, you can presume they're accredited investors, okay? You know, that's fine. But for the rest of us in the world, next slide, well, we have to ask you for your balance sheet and your banking statements and your tax returns and your credit reports and whatever to take a look at that. The problem is how many investors that you don't know do you think are going to be willing to share this kind of information with you? I suspect it's probably 0 to a few less than that. And so that creates a problem. So as a result, next slide, the SEC says, well, you can use other ways to verify that somebody that you don't know is indeed an accredited investor. You can ask them to get a letter from their lawyer, a letter from their financial advisor, from their CPA. There are some companies that have popped up to be able to certify that somebody is an accredited investor. And so you get that, you throw it in your file, and now you've got evidence that you could prove up if you ever get asked that you indeed were dealing with folks that you reasonably thought were accredited investors. Next slide. So, all right, so now you got a process to move forward, which usually, as I say, is going to be kind of a private fundraising. And what are you selling as a young company? Well, of course, the most common thing would be is to sell common stock. You know, every share of stock has, or common membership units if you're dealing with an LLC. And that just simply means that every share has an equal participation in profits. and an equal right to vote for management for the board of directors. The problem is then you have to come up with an agreement between the investor and you guys as to how much your company is worth. And that early on, when you're pre-revenue and you're just getting started, is an arm wrestling contest that often is painful and sometimes difficult to even consummate. So the most common thing we're seeing nowadays for young companies in terms of raising money is to use something called a convertible note. And all that simply means is hey, dear investor, give me your money and we'll pay it back to you in 3 years or whatever, with a little interest. But if we have a funding event between now and the time that the note is due, where we actually sell equity in our company and we price it, your note will and all the accrued interest at that point will automatically convert into the actual equity instrument that we sold to these other investors. But because you came in earlier, you get a discount. The discount's usually between 15 and 25%. I'd say 15 is what you always should start with asking, and you arm wrestle over that. And sometimes we have something called
20.
I'm sorry, what?
I'd start with 20.
You'd start with 20? Oh, see, so Reid would say start with 20, and me, the Lord, I'd say start with 15.
Well, Reid's
Reid's
got the money, so
he wants to grab an extra 5% right away, but
Let's call it 20 and move on.
yeah, there you go. So you see it, but the answer is I will tell you that I see it both ways, so therefore I'm not willing to give up on 15 quite yet. There's a concept called a valuation cap. So think about it this way: if you build a startup that's wildly successful and you have early investors who come on in on a convertible note, and let's say 2.5 years down the way you do an offering that you price, so now it's going to convert, but the value is accelerated way high, which is a good problem to have. But it also means at that point that your 15 or 20% discount is not much of a discount relative to the risk you took to being there as the early investor. So what gets negotiated sometimes is a valuation cap that says, hey, if the value runs past this particular point, we get to convert at that level anyway, regardless of whatever the discount would otherwise say from the other perspective. Next slide. Since we're all here in Minnesota, there is a sweetener that exists in the world I want to make sure you all know about, which is the Minnesota Angel Tax Credit, that says essentially the state will write your investors or give them a credit for 25% of their investment in your company if you're a qualified company and it's a qualified investment and they're a qualified investor, and there's all kinds of qualifying that goes on to this whole thing. And it's a program that has been going on for a number of years, but it's gone on and off. It's on here now in 2021, and it has some relevance still for the balance of the year. Next slide. So just to make it clear, the investment is for cash, can't be for services. It's for $10,000 at a minimum, unless it's a fund, and then they have $30,000 as a minimum. And if it's an investment in a women-owned, minority-owned, or business that's outside the metro area, it can be a smaller investment of $7,500. You either have to purchase equity, common stock, common membership units, or whatever, or what we call mandatorily convertible debt. So you remember what I said about convertible debt, that it provides that it's paid back if there's not a conversion event that occurs before the due date. Well, for the Minnesota Angel Tax Credit, it has to provide that at the end of 3 years, the note is going to convert to equity at some agreed upon price, some default price at that point, if you haven't otherwise raised money and priced it in that time period, if you want to take advantage of the tax credit. Yeah.
Does this matter if you're raising via SAFE, or like if you're just raising a SAFE versus a pure convertible debt?
Well, if you're doing it on a SAFE, so a SAFE instrument, a simple agreement for future equity, is, I'll call it a bastardized version of a convertible note, because basically what it says is, dear investor, give me your money. I'm not going to pay any interest. I'll never promise to pay you back. And if we have a funding event, your stuff will convert. So because that becomes permanent cash in the company, there's no ability to pay it back. You don't have to deal with the mandatorily convertible, because the answer is it's permanent capital in the company already. So a safe by definition already covers the issue.
The state will require that you have a maturity date on safes as well. So you can't take a standard safe like the YC version. You have to adapt it to include a maturity date, but it's only a slight change.
Yeah. From an investor perspective, I'm never very happy about safe instruments because, as you can probably hear, because it seems to me there's not, investors are getting nothing for the risk that they're taking along the way. That's why I think a convertible note is a better arrangement. But if you're an entrepreneur and you can get away with investors investing in safes, good thing for you. So there's also a requirement that that the investor hang on to their stuff for 3 years. Next slide. The company itself, you guys have to be headquartered here. You have to have a majority of your employees, payroll, and current service contracts in Minnesota. If you're dealing with independent contractors, that doesn't count because, well, they are employees. You have to have under 25 employees. If you have employees, you have to pay them a minimum wage of at least $22.30 an hour, so it's not necessarily inexpensive. If you have interns, you have to pay them, I think it's $17.69 right now. You can't have been in business for more than 10 years, and you can't have received more than $4 million of prior equity investments that got you the credit. In other words, $1 million per company is the limit on the amount of credits that can be applied. And the credits are good even if it's an investor outside the state, because the state of Minnesota will write a check to an investor outside the state if they make an investment in the Minnesota company. Next slide. And investors are typically individuals. They have to be certified by the state. There's a process online to do so. They pay a fee. They can be either accredited or non-accredited investors. But of course, for all the other reasons we've discussed, I'd really prefer if you focus just on accredited investors. And there's that $10,000 minimum investment. Next slide. There's fun stuff, but I didn't include that. So the investment itself has to be pre-cleared. You have to report the investment. You have to do annual reporting. So there's a little bit of stuff that comes with it. You just have to remember not to forget to do it, because if you fail to do so, the investor doesn't get penalized. It's the company that gets penalized when the state comes and says, you have to give us back the money that we paid out as a credit. So you don't want to have that. Next slide. So for this year, there was the state allocated 10 million of credits, half of which are allocated to minority, women-owned, and outstate businesses. But what happens at October 1st is of that half that isn't utilized, it goes back into the general pool at October 1st. Right now, we're at 3.1 million that's still sitting around. So there's still pretty good probability that at October 1, there will be money for the taking between October and December. Just remember that if you're an officer or a principal or a 20% shareholder of your own company, you can't get a credit on your own investment. We used to be able to do that game, but we can't do it anymore. The state caught on to us. What can we say? Next slide. Networking events. Well, you know, nowadays it's the big thing. How do you get the opportunity to be in front of investors and speak? And there's always been this nagging issue about the fact that if you're talking to a bunch of investors, is that public solicitation? Does it put you into the category where you're in that different place of how you have to deal with investors? And so that's always been a bit of an issue. We have a new safe harbor that's come up as a result, again, of the changes that came around in March. And now, if the networking event is essentially sponsored by an organization of higher education, a nonprofit, a governmental entity, an angel group, an incubator, an accelerator program, and they don't charge fees for you, generally speaking, to participate, then your presentation there is not considered to be public solicitation. And then you're a little bit free to talk about things. Otherwise, if you're kind of like invited to go speak to a large group, and talk about your company, don't spend your time saying, hey, and we're raising money now, and we'd love to talk to you about the investment, because you just engaged in public solicitation that you may not have intended to do. So the most important thing is, in the end, is follow up with only investor prospects that you reasonably think are accredited investors. Next slide. And speaking of angel groups, you will obviously hear all kinds of stuff from Reid in a moment about Group Capital and their initiatives, but there are a few others here in town. Gopher Angels is currently the largest angel investment group in town, with I think around 85, 90 and members in it. Twin Cities Angels is an active investor. They're a little bit more opaque to understand their processes and network into that organization. And I run a group called Angel Pollination, and we when there isn't a pandemic, 4 times a year, we expose 3 companies to investors over at Interlochen Country Club. Next slide. And our next event is actually, we're going to do one live, I hope, on October 21st over at Interlochen. And as I say, the winner of the Minnesota Cup gets to come and present at this event. And Angie did that, of course, a number of years ago. So that would be my next slide. That would be my comments for the morning. And I'll tell you what, hang on to your thoughts and questions, because we'll roll into the next presentation right now. But there you go. That's probably enough about the law for the day. With that, we go to the next slide. I think our next one up is Rick.
How much time?
You've got, let's say, 20 minutes.
20 minutes, all right.
I think we'll be good on that front.
Okay. All right, so a couple of things. If we begin with the end in mind, I have a call like at 11:15, but happy to stay afterwards to talk to whoever if y'all have questions about anything. Jeff was very truthful about that 777 event that we saw Prince. And if you're a student of human behavior, which I would argue you should all be a student of human behavior, because that's how you sell more of whatever you're selling, and that's also how you raise money, which I'm going to get into. We came in the main entrance in the back corner, like everybody, and everybody kind of filed in and crowded here. We followed the wall and the wall and the wall, and we were like 3 feet from Prince, and it was super cool. So anyway, you all should be students of human behavior, and that will benefit you, which I'm going to go into. David is just walking out, and Larry, a couple of other advising attorneys are people that have crossed paths with. So another takeaway today, which is not part of the presentation, is Minneapolis is a big, small town, Minneapolis, St. Paul, Twin Cities. And you meet people and maybe you don't see them for a lot of years and they resurface 10 years later. So do what you say you're going to do, be a good person, you know, et cetera, because that stuff will come back to haunt you. A little bit of background on me. I started out writing investment research. So analyzing companies was the thing that I started with. I then went into investment banking, which is raising money, packaging companies, selling companies, doing venture capital deals. One of my clients back when I was at Piper doing investment banking, what was then called Norwest Venture Capital, it has since split into 2 groups. Norwest Equity Partners does private equity here in town, and then Norwest Venture Partners went to Silicon Valley back in the old days. Yes, I am a dinosaur, but back in the old days, most big firms had both private equity and venture under the same roof. Of course, that has changed over time as the 2 industries got bigger and more institutionalized. But that's relevant because that influenced my style, and that would be a question that I would encourage all of you to talk to, especially if you're getting professional investors, is what are their belief systems, what are their styles, what are the theses that they're investing in, because that's going to dictate what kind of partner they are for you. So for me, like a private equity person, I like finding something that I perceive to be an undervalued asset. And it doesn't have to be undervalued from a valuation perspective, but more the market. Like I'm going to see things maybe a little different than the market might today, or I'm going to look forward 2 or 3 years and say, hey, I think there's an opportunity there from a valuation standpoint to really to increase. And so that influenced who I was. And then the flip side of that is if you find an undervalued asset, then you got to put on your growth investor hat and you got to do things to make stuff happen. So for instance, Larry and I are working on a client right now, although we did not know that it was a common client. Larry's been working with them for a while, I assume.
Yeah.
From
their startup.
Okay, all right. And then I guess the story there is this CEO was at another startup that raised a bunch of money, unfortunately didn't work. But guess what? That's a learning opportunity. And that CEO spent a lot of years and they had a lot of money and had this fabulous learning experience. And while that one didn't work, that helped that CEO shape what that CEO is doing now. And this person has raised some money already, going to be raising some more, but to the point of adding value. So I was doing some things on the phone yesterday for that company. And there's a lot of stuff that doesn't maybe translate to raising money, but things just need to happen. And so again, Twin Cities being a big, small town, you never know who you're going to cross paths with and how long ago. And we probably crossed paths for the first time many, many years ago. And Jeff and I, 30 years ago, a lot of years, at least 20, 25 for sure. So anyway, do what you say you're going to do, be a good person, and all will be good. All right, so as it relates to looking for startup capital, a couple of things. I'm not going to go into kind of the traditional things that people are going to tell you. I want to try to come up with a couple of things that maybe you haven't heard before, and then I'm going to provide a framework to think about how you're going to raise money, but happy to stick around after this as well as field any calls or emails a day from now, a week from now, a month from now, whatever. All right, so let's get going. First thing is, most of you are going to make the same mistake that most people looking for money do. And I'm not picking on you because it happens vast majority of the time, is you're thinking about it from your perspective. All right, right there, that's a flaw because, hey, I think the valuation should be here because this is the best thing ever. And the investor has a different perspective, like Reid said, about having that discount, wants a bigger discount. Their perspective is they have to make money on that investment. And so if you don't put yourself into their shoes and have empathy for kind of how they're going to view what you're doing, you're kind of missing the boat. Vast majority of the folks lead with, hey, I got a really cool mousetrap, best thing ever. They're going to come flocking to me. I have the best company ever, valuations up here. And as Angie moved to the back, as Angie will attest, a lot of things look like overnight successes, and guess what? They take years and years and years. And so if you put yourself in the perspective, in the shoes of the investor, that will help you. Which means, guess what? They've been told hockey stick up and to the right over and over and over and over. And so you see that and your eyes kind of roll back in your head and you get glossy-eyed, et cetera, et cetera. And those folks are coming at it with a very healthy and justified sense of skepticism. The other thing that goes on, human nature, again, told you to be a student of human behavior. The fear and the pain one feels from losing money or the possibility of losing money overweighs the desire or the greed to have success. And so it's more painful, that registers more as a human being, that I'm going to lose something versus I'm going to gain something. So that again has to drive how you're thinking about what you're talking about, how you're talking about it, how you're presenting. So 3 things as you go out talking to investors. Number 1, you have to build trust, especially for folks that you don't know. Now, Angie and I crossed paths at the Minnesota Cup 2 years ago, 3 years ago now.
We did it 3 times.
Okay, so a couple of years ago, but she didn't have to create trust with me because our kids went to school together. And so I totally knew Angie and we had that relationship. But if one of you came up to me and we don't have a relationship, there has to be a portion of this interaction that allows you to build trust with me. And how do you do that? You have to tell me a lot about your customer, because guess what? If I feel like I know more about your customer than you do, we got a fundamental problem here. And you'd be surprised how many people talk about their business and I start asking questions and it comes to the fore that they really don't know their customer that well. So I put this myself at, if it's not the top of the list, is very high on that list. You should know your customer inside and out, and you should know what makes them tick, what are their drivers, why they do what they say they're going to do, why they are going to buy, et cetera, et cetera, et cetera. And if me, with the various experiences I've had, come to the table knowing more about your customer, that's not a good thing. So really study up on your customer. Second thing would be do what you say you're going to do. Little dirty secret of the fundraising world. It's kind of an unsaid thing. If I drag the fundraising out for a period of time, that allows me to see what you do over a period of time. And so if you tell me something's going to happen we're in August and September, and I just kind of casually drag my feet, whether it's intended or not. And it gets to be September. I'm like, hey, didn't you tell me such and such was going to happen by September? Oh yeah, I did. And that didn't happen. So don't tell people that you're going to do something if you're not going to do it. And similarly, do the things that you're going to, what you tell them. And so it's the under promise, over deliver kind of thing. You do this, especially with new relationships with people, which are going to be most of your investors. This will go a long way. Number two, you have to build emotional connection. I kind of set this up earlier, telling you about studying human behavior. You need to make an emotional connection because writing a check for an investment is a very emotional decision. Why? Because buying, A, is very emotional, and B, people justify that decision with the facts. They say, hey, I'm into what they're telling me. I buy into the market opportunity. I like the business model. I like the people. I'm kind of going through this stuff. And then back where I go back into kind of checking the boxes on some of the other stuff. Do they have the legal work taken care of? Is there IP? You know, I do some background calls, et cetera, et cetera. But I'm doing those things because I've already made the decision that I want to buy. And so this is a very emotional decision. And if you look at it just about the finance side of things, and I can poke fun at finance people because that was my background. In fact, they kind of say I've come to the light side more, market opportunity, go to market, that kind of thing, as opposed to my original training, that being in finance. The facts just fill in the cracks of what they've decided from an emotional perspective. And number three, any high school basketball fans out there? Probably not, probably the same as knowing chess. But if you did know anything about high school basketball, De La Salle won a bunch of state championships, number 3 of 6 in a row. There's my son Eli right in the middle. He also was on number 4, but that doesn't fit the slide presentation. So number 3 is De La Salle winning their 3rd straight title, all right? Which is, it's all about the story. It is all about the story. And actually, if we were in a little smaller room, I probably would go into a little bit more detail about this, but I think you have to be not only good at telling your story, but it is the story, right? You have to create and package up what you're doing just like a Hollywood movie director. You can show me this hockey stick up and to the right, and you can know your customers and you can do all this stuff. But if you don't have a story that would rival any fabulous movie that you would get from Hollywood, it's not going to win. And I used to, I don't know if you caught this, I used to go through each of like the last 10, but it took up too much time. So this year I cut it out. And I'm just going to tell you, if you want to do your own homework, the last 10, it's just like checkbox, checkbox, checkbox. Makes for a good story, makes for, you know, if you think of a movie poster, hey, I'd like to go see that movie. You have to have a bunch of checkboxes. And you can fill in the cracks as to what those need to do. But if you think of yourself, hey, I'm selling this like a movie. I'm going to have a poster. Somebody's going to come, have to watch, dig into their wallet and pay the ticket price. How you sell your deal has to appeal to their emotions and has to kind of follow a script to bring them through. So change a little bit how you're thinking about doing things. And it's not so much, hey, I got the hockey stick up and to the right. It's more about how do I appeal to their emotion and how do I tell a powerful story? And that's going to lead to the money. All right. And added this last year, although we did it virtually, and thank you all for being here. Last year, Jeff said, hey, what's changed during COVID? I left these 3 slides in from last year because I think they're still totally relevant. Some of the things that really bubbled to the surface from my perspective, and oh, by the way, these are just my opinions, doesn't make it right. It's just one guy's perspective of having a lot of years of watching these things. First one, if you can't read in the back, says, ouch, what a blow, losing our biggest customer. Think that will screw up the sale of our company. So the first thing is customer concentration. And so that really became an issue over the last year and a half. year and a half and a month or two, yeah, customer concentration was on the list that people paid attention to, but this popped it up towards the top. So anything that you're doing that really relies heavily on one customer is going to be scrutinized way more than it used to. Customer concentration, much bigger issue now that COVID is upon us. Second thing was supply chain management, and it's just got little stuff here. Oh, by the way, they can get this presentation, right? Yeah, so just ask and reach out and you can get the presentation. Second thing that became clear was supply chain, and actually in some ways this is a bigger issue today than it was a year ago. I'm seeing this through all kinds of problems, seeing this in all kinds of problems, all kinds of different ways. So what changed in fundraising because of COVID? Customer concentration, bigger issue. What does your supply chain look like? Single point of failure, stuff like that. And then the third item from COVID is how are you handling it kind of from a mental perspective? And I guess I saw two different kinds of people over the last year, the ones that were totally freaking out and the ones that were like, hey, we'll figure this out. It's just one more bump in the road and, we'll solve the problem. And you might know who, was able to raise money and do better than the other set. And so just the mindset of how you as an entrepreneur and business leader are dealing with the curveball that you got thrown and we all got thrown, I think really has separated the companies that maybe not only survived, but might have thrived and the ones that didn't do so well. All right, so where do you typically go for money? You go to the friends, you go to family, you go to your typical angel investors and venture capitalists. Okay, we got lots of stuff on this. Not to say that it's easy to do this because it's hard, but that bucket is kind of the normal bucket. And you're going to hear about stuff like that. So guess what? I'm going to go somewhere else, which also would be a theme about raising money. You do it exactly the same as everybody else. You're probably going to get similar results. So think outside the box. How might you do it a little differently? And where else might you go to look for money? There are 8 different buckets that I identified that have nothing to do with the traditional channels that you go through to raise money. We're going to go through each one of them. I won't list them all off here because we'll go through one by one, but there are many different places that you can raise money that have nothing to do with your friends and family, typical angel investors, venture investors, etc. All right, so the first one, contests and prizes, guess what? Here we are doing this. There's other things that you could do, but obviously Minnesota Cup is a fabulous opportunity. Yes, it would be wonderful to win and win the money. I'd also encourage you, though, to accept the fact that only one company is going to win the whole thing. And so it's a journey, and you can get a lot out of everything that you do across that path. All the people you meet, all the feedback you get, the mentors that are assigned to you. Some are going to be better mentors than others. Heard some stories that maybe not all the mentors were doing what they were say they were supposed to do, but that's part of life, right? I mean, an investor says they're going to show up for a coffee downstairs at 10:15, and you go there and they're not there. It's just life, right? So how you deal with that stuff is just something you need to do. And if you soak it all up, keep your eyes and ears open. Minnesota Cup is a fabulous way to learn about the path that you're on. All right. Number 2, crowdfunding. And when we started doing these, Jeff, was how many years ago?
Well, 2012, but really not till 2015 was there for equity stuff.
No. For what we started doing these presentations.
Oh, these presentations. Oh gosh, we've been doing this now for I think like at least 10 years.
Okay, so for a long time. This has evolved over time. Jeff started to touch on a few of those things. A much more viable fundraising option. I would say that the most success is going to come if you view crowdfunding, equity crowdsourcing as not just a financial thing, it's also a marketing thing. So if you have a list of, hey, what do I want to accomplish with this exercise? What am I going to get out of it? If you look at it as 2 different things, marketing and finance, you're going to get the most out of it. But this is a way to raise equity outside of the norm. Number 3, your customers. Guess what? If you really push people and you're solving a need and you ask somebody to prepay, or it's August and you say, hey, Q3, we got a Q3 special, or we start getting close to end of the year and buy now, get a discount for next year or whatever. A lot of ways you can spin this up, and this is non-dilutive. Oh, that's another thing. Most of the things that we're going to be talking about here in this section are non-dilutive, which are a great way to raise money. And this also validates what you're doing, which makes you more attractive to the folks that you're talking to about raising money. And so I would encourage you all to think about, hey, how could I package up what I'm doing and kind of pre-sell it to customers as a fundraising strategy. Vendors, people who are going to benefit from you having success are going to want you to succeed. And oh, by the way, guess what? They might give you better terms. They might even invest, all kinds of things. You're not going to get it unless you ask. And so if you view the people in your orbit that are going to benefit from you doing well, if you view them as a source of capital, whether it's just extending a runway or actually literally giving you $1, this is an option, works for some people. I'd encourage you to at least consider it. Next one, the distributors. There was a medical technology company that I was involved in a number of years back, and we raised 3.5, 4 million of about the 10 that we raised from international distributors who wanted exclusive distribution rights for their countries. Now, we were selling something that not all of you can sell. With that said, there might be some kind of distribution relationships that people might be willing to pay up for, and it's an indirect pay. They want an exclusive, or they want something before whomever, or what have you. I just encourage you, like with all these, to just ask yourself the question, is this a source of capital that I might be able to tap into? Government has all kinds of programs, whether it's funding research, whether it's loans. Many of you may not qualify for these, but again, we're just having a checklist of things to ask yourself, hey, is there any way that I can tap into these dollars? We have Pat Dillon in town that's an expert at helping people raise SBIR dollars. Many of the banks, including Highland Bank that I'm on the board of, and they're an investor with me, are quite good with Sba Lending. And this, like all these, again, is a way for you to raise additional money for your efforts. Specialty finance right now with relatively low interest rates. People are looking for different ways to put money to work, and a lot of folks that might provide some sort of equipment financing or whatever. These people are, I don't want to say throwing money at businesses, but it's loose, and a lot of you may not have the time horizon of where money's tight, money's loose, money's tight, it's just up and down. Right now, all kinds of folks with capital are looking for ways to put money to work. And even if it's just buying equipment for your own business, this is a way to extend capital and help your company. Economic development, number of years ago, this wasn't even a thing. So if we had done this 10 years ago, 15 years ago, this really wouldn't have even carried the weight that it does now. Many communities are fighting over this. There's Justin Erickson. Do you know Justin? Justin Erickson is at Essex Capital, I want to say. ESSEX. He puts on an event once, twice a year where he's got a couple hundred rural communities that get together and they hear pitches. I think he might even have one yet this month. If you think your business could create jobs in rural locations, I'd encourage you to look up Justin. I can give you a pointer to him if that would be of interest. The other thing going on is you can just get in a car and drive up 94 to the northwest towards St. Cloud, and all of those communities are sprinkling money out to companies trying to build their job base and their communities. And so this is a card you can play in many different ways and is a much more significant tool for funding companies now than it used to be. All right, so you got a bunch of different ideas there beyond just kind of the norm. Again, not going to work for everybody, but if there's one thing on this list that you can take with you and benefit from, that's great. Maybe there's more than one, but again, there's 8 different questions you should be asking yourselves and your company about raising money. How do you make it all happen? First thing is network early, network often. You never know who you're going to meet that's going to turn you on to somebody that can add value to your business. Tell your story to whoever's going to listen. Person behind the cash register at Trader Joe's, somebody down in the lobby downstairs. You get feedback like, hey, I don't get like the business model, or I don't get this, I don't get that. You're going to refine what you're doing. You're going to feel more comfortable giving the pitch, which is also part of raising money, because the natural progression of a human being is I'm going to put you into a bucket that you make me feel comfortable, or I'm going to put you in a bucket that I don't trust you, or you make me feel uncomfortable. So all this practice and repetition will help you, and you never know where you will get something. You want to, best as you can, position it as a must-have versus a nice-to-have. Goes back to the story. So if you're sitting down and you're creating the script of how you want the story to go, the best way to be is to try to do it that somebody has to have what you have. ROI, Reid touched on it where he said, hey, a 20% discount. It's natural human nature for people to want to get the best deal possible. The other thing that I think, if you're not empathizing with the investor, is people that take other people's money have to return a high enough return to those people that justifies their existence, our existence, my existence. My fund is some of my own money, but also from Highland Bank. So I have to go to Highland Bank and I have to say, hey, we returned what I said we were going to return. And you therefore have to be ROI sensitive, because that's going to drive how they're going to do versus, hey, I got the best deal ever and the valuation should be way up here. Talked to a guy yesterday that is very early in the fundraising process. They have a few customers and they had a $5 million valuation. I just said, hey, people may invest in that because they know you, they like you, they trust you, but somebody who's comparing that to a bunch of other deals, it's off the chart relative to where you're at. And so you really need to consider the investor's perspective when you're pricing your deal. Next one. Multiple lines in the water, like I listed 8 different things where you might get money that are non-traditional ways to raise money. Don't just say, oh, I'm talking to party A and I think they're going to invest, and then therefore I don't have to keep doing this stuff. For anybody who's done downriggers and fishing here in the upper Midwest, or I guess the ocean too, you gotta have multiple lines in the water because you never know what's going to pop. Validation, traction, revenue, these are the kinds of things that the people who have some questions around what you're doing are going to resonate most with. This is the easiest thing to get comfortable on and have the highest impact. So whatever you can do to create these things as fast as possible is very important. Why? Because being wrong and being early look exactly the same. And so if you say to yourself, hey, in fact, that was part of the conversation I had with this gentleman yesterday, is he was saying, I don't know if I should keep at it. And so, well, from my perspective, you're far enough along, you should keep at it, but your valuation's crazy high. So reflect on that, maybe lower that down. But being wrong and being early look exactly the same. And so the faster you can get out of that phase, meaning validation, revenue, customers, any kind of positive reaction from the marketplace is going to benefit you. Gentleman I did an investment with a million years ago. It's not the only person that said this, but that was the first time I heard it. Are the dogs eating the dog food? Just a yes or no question. And if the answer is yes, now all of a sudden I can flip gears and go into the I'm more ready or interested in buying. So are the dogs eating the dog food, good takeaway? And trying to get money, and they're like, gee, I'd like to invest, but guess what? My pockets are empty because this traction we just talked about is really the driver to everything, and it doesn't have to be revenue. It might be pre-orders, it might be beta users. We have, one of my companies has about 15,000 non-paying consumers with an app. That non-paying app for us is like the gateway drug to a business-to-business thing, and we're basically running an end around. So the fact that we have 15,000 consumers who aren't paying yet is part of our business strategy, but we have 15,000, so we can talk about that. And so anything that you do that can be translated as traction is going to benefit you on the fundraising. Bunch of different ways to reach me. I do have a pool of capital. It's my own money, as well as I mentioned Highland Banks. Invest up to a couple $100,000. With that said, I'm worth way more for what I can do versus the checkbook I bring. My portfolio of about 10 companies in the fund have now raised about $80 million. Much of that I help facilitate. And Jeff is selling a company right now that I've helped over a number of years. And so while my checks are modest, it's not just about the size of the checkbook, it's also about the spirit that they bring, value they can add. And again, I mentioned at the front, what's their philosophy? How are they going to help you? And I would encourage y'all to interview your investors, just like you might interview an employee. Yes, you want their money, but a problem investor is a problem investor, and not all the money is green. And Jeff and I at that same company that now is being sold had a problem investor that was a big problem. And so interview your investors. Don't necessarily take them in just because they bring a check. Again, I'll stay longer. I think I hit my time roughly, give or take a little. I'll stay longer. If you have any questions, you have my contact information. You can reach out to Minnesota Cup or Jeff to get that. Thank you for being here. Good luck. Enjoy the journey, because it's not just the destination. Yes, Angie won, and that's fabulous. I'm guessing, though, that she would say that she also learned a lot on the years that she didn't win, and maybe the reason she did win is she did it multiple times and she learned and iterated and improved. And so again, enjoy the journey, soak it all up, and thank you.
Mr. Reid, okay. I might run my own slides if that's all right.
Oh, yeah.
Tablet. It'll just go faster. Okay. Well, a lot of information so far. I'll probably focus more on like where to go. Now that you figured out what mentality and like frameworks for thinking about your pitch, we'll get into that a little bit at the end. But where to go to get capital, and that's your answer. So I have been a little bit about myself. I've been in a few different seats. I co-founded Beta and Twin Cities Startup Week. So I've been working with founders like you through those things for 8 years now. I've also been an entrepreneur in a few different size companies. We got second place in the high tech division in 2013 or 2014. I don't really. What's that?
It was before me.
It was before you. That's true. It was before Melissa too. So yeah, I know the experience. It's a good program. It forces you to develop a plan, probably more so than you had at the beginning. So I think there's definitely value in there. And talking to I think one of these founders earlier, that my mentor that I met through that, I'm still connected with today. Gentleman named John Tedesco. who's this incredible entrepreneur, and that's the cool thing about this network is you get exposed to really interesting people. So I bundled all of the like community building infrastructure work with all of the things that I had learned as being an entrepreneur, and then I moved it into an investment vehicle called Group Capital. So you may or may not agree, it's really hard to raise capital, right? Especially being entrepreneurs in Minnesota. Well, everywhere you're going to go, you're going to hear entrepreneurs complain that there's not enough investors. That's just what entrepreneurs do. But we actually do have an issue here, and it's actually two issues. First of all, there's not many angels to begin with. And then the other one is there's no institutional investors investing at the stage that most of you are at. Well, large majority of them, first of all, there's not many to begin with, period. And then the ones that do exist have raised larger funds and write larger checks and therefore have to go a little bit later stage. So that's the problem on the institutional side. It's not that any of them are doing anything wrong, it's just the nature of the way that the math works. So you have success, so you go raise more money. If you raise more money, then you have to write larger checks, and therefore you move later stage. So it kind of is this vicious cycle of not being very helpful. On the angel side, it's a lot of people say it's because we don't have like the risk profile. I don't think that's right. I think most angels don't, most people who have a lot of money don't know that you exist, and they don't know that startups exist. Most of them work in these buildings and they put all of their money into their 401ks. And that's where the majority of the wealth is stored. This all came from the Angel Tax Credit, which is a great program, by the way, but only 52 people in the last 10 years have used it 5 or more times. So that's not a lot of people. So Groove Capital is a solution to try to solve both of those problems. It's two things. It's a fund and it's an angel group. The way that it functions as both is the LPs and the partners and investors in my fund actually get a chance to increase their investments in the companies that we invest in the fund. So they double as angels. So we have essentially 100 plus people who are looking at your investment, the opportunity to add more. So it's now the largest angel group, Jeff. So yeah, what do? We invest in the pre-seed stage. That means different things to a lot of different people. It's a stage prior to where a majority of the activity currently exists. We're going to invest in 50 plus companies within 3 years, so it's really high volume. It's a lower check size. We write a check between 50 to 100,000 from the fund. And then, like I said, we then take that deal and we share it with people to co-invest, so they add on top of that. So there's actually 2 pools of capital. And we're focusing our efforts on entrepreneurs in Minnesota. We made 15 investments since February, so we're on our way. These are too small to see, but the main point here is, in thinking where to go to get an investment, the amount of money you're raising is going to determine who you should be talking to, generally speaking. They don't actually sit like super tightly in these verticals, like bread and butter or matchstick, etc. will make an exception and go earlier. They'll also go later. We'll make a seed stage investment if it makes sense for us to do, but generally speaking, like we want to be in the pre-seed $250,000 to $750,000 raise space because there's no one else there, and we think that it's a great opportunity. But it turns out we do have a lot of really great investors, and the investment community that we have in this town is very bright, like interconnected. They work with each other. They're collaborative because I think they recognize that there's still so much opportunity for everyone to play that it's not super competitive, generally speaking. So The cool part about the investors in this town is, I think everyone, generally speaking, is looking out for their interest and your interest collectively. It's not super aggressive, or totally over competitive. So be thinking about, like, you know, if you are raising a $5 million seed stage or Series A, whatever you call it, $100,000 from group probably doesn't make a lot of sense. But there are a lot of other people that you should be talking to that's their normal check size, especially if they're writing larger checks. So that's one of the way to determine who to talk to is the amount of money that you're raising. The types of businesses that we invest in, we like, it's usually just the founding team. Some cases there might be one or two employees, but it's usually founders. They have you know, conviction in what they're working on, an MVP or a prototype, something to say like this is actually real. We've put effort in to show that whatever we're working on is possible. Rick mentioned like executing and seeing change over time, and that's really important because we don't have any qualifications from a revenue perspective, but it needs to have existed long enough for you to show me that you've made a plan and you can execute on a plan. And if you've shown a couple of those data points along the way, then I'll anticipate that you can do that into the future. Yeah, and then probably the biggest points and one of the things that we probably see missing most is like, what is your vision and your grand vision? There's a lot of incremental stuff out there and pitched very conservatively, and it's starting to drive me crazy. Like if we're going to invest and we want, you know, to grow our companies and produce a return, like we really want you to go for it. So, you know, it's a delicate combination of like, you know, not overinflating what you've already accomplished, like incrementally, what have you built along the way, but where is this grand place that you're going? And sometimes we don't necessarily relay that. All right, so what do we look for? Industry-wise, we'll invest in anything that makes sense to exist in Minnesota. So thankfully, we have a lot of really great industries and verticals here. Basically, if you just follow the divisions in the Minnesota Cup, those are generally the industries that we want to invest in. And there's a reason that they exist in the Minnesota Cup. It's because there's mentors, there's potential customers, there's investors in all of those spaces. So we have all these resources that align by vertical. Okay, well now I know that if you're starting a company in that space, you can grow with those resources. So it basically follows the cup. Like qualities wise, and you know, I'm sure this is probably what Rick looks into, and everybody else, like you kind of have the traditional stuff, market opportunity, timing, runway, competitive advantages, and then there's like the non-traditional stuff. Because we're operating earlier stage, like the data that you have that exists in the traditional categories is very little. So we have to lean into you and the team ability to execute. Like, how do you take feedback? That's your receptivity. And that's also a balance. You know, you want to be convicted, but coachable, somewhere in between the two. If you're too far on one side or the other, it's probably not going to work. Your focus, also a balance of, you know, not too narrow, not too broad. Determination, like if you haven't already got to this point, you're going to get to a point in your business where it's going to suck. And like, can you go past that? And people who are in their startups for the right reasons generally will get through that. And because they're super passionate about what they're doing. I like that Rick brought up storytelling. That's a big component. It's probably like most simplest forms. Like I think the two key ingredients from a team's perspective are like, you've got to have somebody that can tell the story and you have to have somebody that can deliver on the story. So I call it the builder and the seller. It's usually not the same person because those are very different skill sets. But substance of the ability to build and solve a problem, and then somebody that can actually get people fired up and believe that there's something to that. And then financial literacy is kind of built in. So when we look at all of these things, we actually have questions that gauge all of the stuff that I just talked about. So we, in our process, actually are trying to evaluate some of those non-traditional criteria. But if for like a memorable, how do I want to like package my pitch, either to Groove or somebody else? We like the jockey horse racetrack thing that you hear in a lot of different places. The jockey's the team, the horse is the product, the racetrack is the market. But then I've added two more. The ticket is the deal. If your deal is messed up, Rick shared an example earlier, it's almost like a hard no. It's way overvalued, like you didn't do your homework, I'm out. And then the thesis is kind of a precursor. It's a nice way to filter to say, for us, hey, you're located in Texas. We invest in Minnesota. Like, why did you not look at that on our website? It's a no. So like our thesis is a nice way to, kind of focus the funnel and make sure that we're talking to the right types of people. All right, so it's probably too hard for everyone to see. I was going to say, like, raise your hand if you want me to elaborate on any of these things, but we made 15 investments. We've looked at about 20 to 30 deals per month since January. And I've seen some themes of things that are successful and things that are not successful. So I'll start with the do column. Actually, I'll go to the do not. So, if you just starting out your investment process, like build your list of who you want to talk to, and then qualify your list of investors, because what you don't want to do is talk to your best candidate first. I had this come up, somebody that hadn't raised for a long time, got back into raising, came to us, who was by far the most likely group in town to invest, and totally blew the pitch. Like, just hadn't done it enough, hadn't practiced it enough, hadn't heard it enough. And you can tell they hadn't gotten to that rhythm, and we got past it, but it was kind of a miss on the entrepreneur's part to go right in. Don't disqualify yourself. So if you see, any investor that has their criteria listed, usually they're not like super rigid. There will be some exceptions made, so don't disqualify yourself from the process. Like, ask them to disqualify you, because there may be some instances where they're willing to make an exception because they really like what you're working on, and we do that too. Don't cherry pick the most favorable information and apply it to your circumstances. I will put that in the framework of like how to position your deal. We had someone in January, so this is really early on, who was coming up with a valuation cap, I think on a note or a safe, I don't remember. That was something like $19 million. And that's the largest, most ridiculous one that I've seen so far. And the information that this person got from was like, oh, okay, I'm in e-commerce. I'm gonna go look at other e-commerce sites, in this case, like Etsy, and I'm gonna see what they did back then, and then apply that to what we're working on now. Well, first of all, like, you're not that founder, you're not in California, and the scope of what you're building is completely different than that. So you're 20 times off what your valuation should be based on where you're at, and you've used information that didn't actually qualify for your context. Don't outsource your investing process. this goes back to the storytelling element. Like if you can't articulate your story well, then you need to have that on your team. I don't think it's very, like, it just sends the signal to us like, okay, well, they get the money, like, how are they gonna tell their story to their customers? How are they gonna tell their story to the next round of investors? That has to be a built-in capability. And it's generally a turnoff. I would highly suggest not doing that, though there are a few exceptions. That leads me, if you're not comfortable asking for money, you might not be the right person to be the CEO. And I think that's something that like might be hard to hear sometimes. But be self-aware is like self-awareness is a huge asset for you and your team. And if you're finding yourself struggling through that process, it might be an indication that you're not the right person to be doing that. Doesn't mean you're not capable of it, but it's going to take you so long to develop that skill set, and time is of the essence. It might be more valuable to find somebody who's equally as passionate about it, who does have that skill set that can be successful. Don't lie or exaggerate. I just saw this in a deck the other day. They listed an investor. I talked to that investor. That person was not an investor, but they were in the process of talking to them, and that's just like a hard no. And it's just such an easy thing to avoid. Don't do that. You can say that you're talking to them and that they're interested, but don't position them as something they're not. Same thing with customers or any other points in your deck. Like, just say what it actually is. Don't torch things on the way out. That's only happened once. And Rick mentioned earlier, this is a small town. And so just treat people normally. It sucks to hear no, but take it, put it up on your bulletin board and throw it in my face or another investor's face when you're a billionaire. But be respectful. Like, we want to be respectful of the founders, and I think it goes both ways, because if you blow up because you hear no, it generally isn't going to help you with other relationships in the future. And if you do hear no, like, it's probably because of the other things in the construction of the portfolio, the way that the venture, it's not you, it's me. Like, it's the entity, it's the strategy that you don't necessarily quite fit in. So don't get discouraged. Like, what you're working on is important, and you should continue doing it, finding other ways to get it. So now on to the do side. Read the website, ask questions. We have office hours, and I think everybody else does for the most part too, but that's like a really low entry point and low risk way just to be like, do we even qualify? Should we even go through this process? I love those conversations. We just had one. Because then we get to talk, like, what are you working on? How can we help? If it's not me, maybe you should go talk to so-and-so, and I can direct you to them or even make an intro to you. So asking questions is helpful. Research who you're talking to. It's going to take time, so prepare yourself for a process. Do what you say you'll do or more. Rick mentioned that too. Here's a great example of that. I talked to a founder in March. We weren't interested in investing, but I said I was interested in following the progress. The founder said, all right, I'm going to send you an update on our KPIs every other week. Awesome. I will read your email. Please send me it. Never did. And it was just like, well, why did you tell me you were going to do that? You just set yourself up for a scenario where you said you were going to do something and now you're not. And every exchange that you have is an opportunity to either do what you say you're going to do or more. And it's just so simple, but it's very often overlooked. Find reasonable comps for your fundraise. Here's the analogy that I use. Like, if you bought a house and you're trying to figure out what the price of the house is that's fair, you don't look at what houses are selling for in Oakland. You look at the ones that are immediately around the house on the same condition, the same situation, like that's how you should be valuing your company too. You have to put it in context. So make sure that the information that you're looking for has the same level of details. It's okay to be not perfect. I like self-awareness and like acknowledging gaps on the team. This isn't a skill set of ours, but it's our plan and our hiring, et cetera, et cetera. Start with the end in mind and work backwards. It is basically if you're trying to figure out how much you should raise, go like 3 steps past where you currently are, and then work backwards to what is it going to take for you to get there. And that's related to the comps. You can look at other companies that have gone before you, that have gone through those stages and get to some level of answering that question. Substance is going to win every single time, and then balance that with like a big broad vision that's exciting for us to invest in. So I share these from our own experiences, but I think they apply generally speaking to most investors. And I'm sure there's going to be a totally different list in the next 15, but do these things, don't do those things. And this is how you can get a hold of me. And that can be our entry point into an investment process. That's it.
You want to take it back over now for Andy?
All right, last but not least, I think I have 10 minutes or 5, or what time are we? I mean, how?
Well,
what time are we supposed to-
we're called to be a 10:15 gig. It's
Okay.
9:55,
Okay.
and maybe we'll have a few minutes for some questions. So
Okay, perfect. I'll try to go fast. I'm Angie Zabarro-Conley. I'm the CEO and founder of Abilitech. I put together some learnings from the last few years. And so next slide, thanks. This is a quick video that will start playing. And why don't you,
So
I
next
think it's the
slide,
next
Doug.
slide. It just shows a little bit about our device. We're the wheelchair for the arms. If you can't use your legs, there's a wheelchair. If you can't use your arms, you have MS, ALS, spinal cord injury, muscular dystrophy. There's now Abilitech Assist.
Okay.
We're starting a muscular dystrophy
14-year-old was
study at
diagnosed
Gillette.
with muscular dystrophy before
all right, we'll go back.
And this is
a Gillette
a
Children's
special that
Specialty
Carol
Health
Levin
in
did.
St. Paul. Joe Borboom is showing how he lifts up objects from spoons
To use both hands, okay.
to water bottles. The 14-year-old was diagnosed with muscular dystrophy before his 6th birthday.
He's lost all function in his legs, and his arms are weakening.
Mom Jessica helps her son do things like brush his teeth. Other tasks that can be a challenge:
Drinking, eating, scratching an itch on my head or something.
but Joe has started using the Abilitech Assist.
Joe, so I'll have you just relax here.
It supports and assists both the shoulder and elbow.
So our device has springs and motors to help create custom profiles for patients to support them in lifting different weighted objects.
Going from this
Good.
to this with something as lightweight as a spoon,
Great.
or this
Can you move the can to my hand over here?
to this with an item as heavy as a 12-ounce can.
How's it feel when you're doing that?
Pretty good.
Pretty good. Something like this could be life-changing, that it could offer him to be able to do this stuff by himself and he wouldn't need help.
It's way easier.
With the weightlessness of this arm, it's just fascinating.
Really help quite literally open doors for people.
Angie Zavarro-Conley is the founder and CEO of Abilitech Medical. The Eden Prairie-based company got its start nearly 5 years ago.
When we are able to fit a patient and see the lights go on in their eyes or their parents' eyes and know that we're making a difference in their lives is just a phenomenal reward.
We're hoping that it'll affect a whole lot of children and adults with disabilities.
Dr. Mark Gormley at Gillette will be leading new research. Abilitech is teaming up with Gillette and U of M to study their device.
Yeah, that was awesome.
So we can go to the next slide. Thanks. And so I thought I'd kind of categorize 5 things: attitude, what you can do internally, competitions, the type of opportunities like the Minnesota Cup, the Techne Award, which we won after the Minnesota Cup, which was great. There's an EY Entrepreneur of the Year. There's other things. That's all great visibility for your company. And it really has been helpful. Accelerators and Incubators, we've been part of 3, and then fundraising strategy and legal advice. So next slide, thanks. So the fonts get changed when you import them, so it's a little weird, but the first thing on attitude is one of our board members said, learn how to be comfortable being uncomfortable, because you're in a new frontier. You are doing things you've never done before, and it's scary sometimes. It's exhilarating, but it can be scary. And then you're gonna make mistakes, but usually those mistakes are winning and you're learning. And so I know John Stavig is famous for saying win or learn, but it's true. Say to yourself, and don't beat yourself up. Hiring. So the first 2 years, we were 2 people and a bunch of contract people, and then we expanded. I've learned something really, I think for me, that's been powerful. I've hired some kind of big dogs from big companies, and they don't work I mean, they really don't. It's crazy. Like, big salespeople come in, or, not, from an advisor or whatever, or, it takes a scrappy mindset, and you really need to pay attention to that. Very few people make that transition from a big, and you're kind of, at some stages you want to go deep, and you'll need that eventually, but really we're at the stage where I wear 14 different hats. I mean, I'm like covering all different kinds of, and the people you hire, you want to hear them say, yeah, I'd love to learn how to do that. It's this growth mindset. And that is the really important and fun part about a startup, is you're always learning. So, contracted positions are really effective. Imposter syndrome, if you haven't heard of it, it's real. I mean, you're doing something for the first time, and it's natural to kind of second guess, because you haven't done it before. And you think, oh my gosh, who am I? Like, I raised $12.5 million, $2 million of non-dilutive SBIR funding. And I, didn't think I was going to be here 10 years ago. And so it's really kind of exciting. And I think you just have to tell yourself sometimes, I can do hard things, and you do, and believe in it, and not be beating up on yourself, and trusting yourself, trusting that intuition, and actually acting pretty quickly on that. And you kind of get better and better as more seasoned. So next slide. So Minnesota Cup, the first time we went through, it was to explore an idea, to be able to say, hey, this is something that is an unmet need, and let's look at this market size. My background's in Medtronic, so I had that business skill acumen to be able to say, all right, people are, this could help stroke and muscular dystrophy and spinal cord, et cetera, et cetera. So I went through, and there were 3, as you know, the video, which is your most powerful tool, your pitch deck, which is amazing to be able to use, and then the business plan to kind of, and that mentorship. If I were to say, like, the year I learned the most, it was that first year, because we were in the infancy, and I went to all these type of meetings like this, and I was learning and a sponge. And then as you build and build, you're refining your business model. So luckily, I actually dropped out. Stemonics was going to win, and they were in our competition in our bracket. And I was like, wow, we're like just an idea, and they have business contracts and et cetera. But I dropped out because with the Minnesota Business Cup materials, those 3 things, the pitch deck, the video, and the business plan, the first person I pitched, and I can't even believe how lucky I was, I had no idea, I secured $2.5 million or $2.3 million. So within a few months of being able to, so the Minnesota Cup, I kind of credit to like the birth of our company, being able to start. And then it took 3 times to win. So, we kind of went back again. The second time we were kind of bullish thinking, and we didn't even make it to the semifinals, and we were like, what? And then, the third time it was like, okay, I'm hoping that we're at this stage. So hang in there.
Why the tenacity? Why did you do it 3 times? I mean, because it sounds like you were already tracking. Are you just that tenacious, or what was the driver there?
Because I'm competitive.
Okay, all right.
I'll be perfectly honest. I think there's opportunities for that, for the PR that's free and good. I think that there's a way to kind of refine and investment opportunities as well. So, and I was told that most people don't win it the first time, and you got to keep keep at it. So that's what I guess I'm telling. You do have to weigh, is it worth it? You know, are you at the stage where you really, because it does take time. But at that stage, that year, we had a business plan. We already had a pitch. We had all the materials done. So we were kind of refined there. So it wasn't the third time, it wasn't that hard.
Yeah.
It's the first time, right, in the infancy. But yeah, I mean, I think there's a piece of competition that's like, this is my hometown, I'm gonna do it. So, and it's great, you know, coverage. It's great opportunity and networking and understanding and meeting. So next slide, thanks. Accelerators and incubators can be great learning potential. We're a med device. The best one was Texas Medical Center. They have an accelerator, which is this economic engine. And if you contrast Minnesota versus Texas and how they differ, it's quite different in their funding infrastructure, how they're feeding these companies. They would have built us a building if we wanted to stay there. They connect you with, there's 22 hospitals within a 3-mile radius. We had 2 clinical studies there at the largest children's hospital in the world and at Houston Methodist. You know, they're giving you funding, they're introducing. And then as soon as I said, yeah, this is great, but the workforce is really deep here in Minnesota and I'm not moving, then it was sort of it, but I learned a ton. I learned a lot there. We are in a Praxis spinal cord injury accelerator in Canada. And so, but it was funding. It was $40,000 of non-dilutive funding. And then all these opportunities, and what it helped us learn is a lot more about spinal cord, and it reordered our market size and our strategy. So we learned a lot. And then the third was the springboard for women entrepreneurs here. That's a really great opportunity. Springboard Enterprises, 700 or 800 women entrepreneurs have raised 20 billion in capital and 20 billion in IPOs. So, and then tailored programs if they're distracting. Next slide. So fundraising, the best thing you can do the first time out of the gate is get a good CFO who understands how to do this, who understands what the terms are. I'd argue it's even more important than a lawyer initially, just to help, but they're equally important, but a CFO will help you navigate, and they can also make some introductions to other investors as well. The lawyers, you got to understand your terms, and I misstepped. I mean, I don't own enough of my company right now because I didn't start with a good lawyer. So you got to start with a good lawyer as well. Don't be discouraged. Minnesota's tough. And guess what? I've raised $12.5 million, and less than 400,000 comes from Minnesota. So we are known as a flyover territory. We are value, we're workers. We've got this this Midwest ethics, so the coasts that are overvalued when you're paying high salaries in Boston or San Francisco, they value, but there's some people, our biggest investor is from Texas, and they only invest in the flyover territories. So sell that, because that's important. And also, fish where they're biting. I mean, I'll have to say that there was one angel group, yours, that I got an investment out of, and the 3 that I pitched. So it was hard. So it was a lot of work. And so, when you start looking at it, be realistic. And coming from Medtronic in this land of medical device, I was completely baffled that the medical device funding for early stage is just not here in Minnesota. Some of the smaller VCs, make sure that you're aligning, like you said, with the mission of the scope of who they invest, what size they're investing, what their average check size is. Are they med device or are they electronics? Are they, and you just have to make sure that you're honing in, you're not spinning your wheels. Choose your board members wisely. I have learned that over and over in time. Right now, I have one working board member who's phenomenal, and we meet weekly, and then the others are VCs and they help, but I need more working board members. So make sure that you're getting people that can really advise you, watch this.
I just had a quick question about raising money out of state. Did you just embed yourself in different territories and just stay there until you raise capital? Or were you mostly just working the phones and emails from Minnesota?
So angel groups can be really powerful introductions to other investors. And so that was one way that I got through Resi redefining or early stage innovation is a conference that really, it's like a speed dating with investors. That seemed to work really well. And then you've got to find the investing meetings. And what I did is I hired an intern to figure out who's within and sift through and give me exactly who I need to focus at each meeting, so that I'm reaching out, and if I'm going to pay $1,000 or $3,000 in some cases to attend this conference, I've got to make it work for me, and I've got to be prepared, and I've got to know that I align with them. So, and then conferences like Resi. And then one of the biggest important things that you need to do is when you're raising money, align them with inflection points. You got to see what are your outcomes. Right now, we're about to begin, a fundraising thing. I can't talk about it, but
You're not raising money in this group.
I'm not raising money in this group, but it's to get sales outcomes and clinical outcomes and reimbursement to be a huge. So it happens to be a convertible note. It happens to be 20% with an 8% interest rate. The market cap, often becomes your pre-money for the next valuation. So, I mean, some of the things you said were really resonated with us or with me. So next slide. Legal advice, you got to understand your term sheet. So don't be afraid to sit down with your lawyer and say, what does participating preferred shares mean? What does pro rata mean? And don't be apologetic. If you're like working 80 hours a week and then you've got this term sheet, and sometimes there's like, okay, I already got my attorney and I'm trusting them to help filter, and that feels like you have it, but understand it. And you do need to understand it, and don't be apologetic about saying going page by page, what does this mean? Because you do need to understand it. A lot of this discussion has been multiple small investors, and I think it's important. What I've learned is to incorporate in Delaware, because when you have a lot of players, that's one of the things. I mean, I don't know if you agree or not, but the small investors don't have the same rights and they can't derail you. So that's something to, starting with the Dropbox and something online to kind of organize. We have a data room right now, so I tried to show you kind of an outline of what is starting to look like, but articles of incorporation, you got to keep all your board and shareholder minutes. In our case, we have a clinical file, a competition file, contact info and references. In our case, the doctors that we work with and our board members. Our current cap table, once you get pretty complex at our stage, we went to Carta online. Super easy. You can do valuations with 409A. It's expensive, but it's worth it. I think FDA stuff, finance, all the projections that you have, human resources, you got to keep track of all your contracts, any sort of legal issues that you may have had, investment terms of what the deal is, any sort of legal issues, contracts of what you've had, leases and whatever, patents for us, press releases, our reimbursement, our stock option plan, and strategic documents. One of the things that you start with this business plan, and then last year our board asked me to let's do a strategic plan. And I was like, what? Okay, but at Medtronic it looked like this, and it was just really hard. That document has been so helpful for us. Every single quarter we measure against and do a quarterly review. Where are we? And what it does is it allows you to kind of go forward and say in 3 years, 5 years, we want to be here. And this is how we're going to get there. And you build it instead of like, here's where we are. We think we can do this. No, you kind of go and you set your vision, where you want to be, and then you backfill. So that's really been an important piece. Some of you are probably too early, but it's not too early to start thinking about that. And then every single person has goals and out of objectives, measurable objectives. So it makes it really easy to do quarterly reviews with your employees and start looking. So just, and then we do these quarterly reviews And then I take all those and I've got all my board materials right from that. So we do it 3 weeks earlier than our board meeting, and that's the first thing here's where we are to plan. And then, and I guess one of the last things is mission is super important, especially when we're working so long hours, and it carries that, sometimes it's a grind. And, you just think about, my job has greater meaning than just a job. It has some sort of purpose, and you keep your eyes on the horizon. And that's been a really incredible, it was motivating for me when I was at Medtronic, that maybe what I was doing was kind of, you're an inch wide and a mile deep at a big company. And here you're a mile wide and hopefully a foot or two deep, but you're the wheel. All of a sudden you're the cog in a big company and you're the wheel. And sometimes, it's a roller coaster, but it is that mission and vision really, really is important for hiring and for keeping everybody engaged and aligned. So next slide. I think that's it. Thanks.
All right, well, we technically are done at 10:15, and certainly if some of you need to leave, that's fine, but we also want to at least take a few minutes to answer questions you may have of anybody on the panel, and then obviously we can stay around and have some chit chat as well too. So any specific questions of anybody on the panel, go ahead.
This is for any of the speakers, actually, but from an investor standpoint, what factors, if you could distill them down, it's maybe too broad of a question, what factors, when you hear a pitch from someone's valuation, makes a good, fair, accurate, honest valuation from the person giving the pitch? I mean, finding a good comp, if that's good too, but like what other factors do you see that you think goes into a good, fair valuation of business when they're pitching?
So I'll go first, and then you'll hear from the real people on it. So my view about valuation with early stage pre-revenue companies, many of whom are like you guys in the cup, is that there's just a rule of thumb. If your valuation is much more than $1.5 million or $2 million, and different investors will have different views around that here in Minnesota, you're probably getting outside the range of what investors are going to be willing to invest into. And it doesn't, you can stick your finger up in there, or you can do any kind of valuation stuff you want to do. The bottom line is it's an arm wrestling contest. Investors probably want to get 1/4 to 1/3 of the company for the right amount of money in your capital when you're going out to the first set of investors. And that's my rule of thumb, the way I think about it. Reid, what do you say? You're writing the checks today.
I would say the context piece of what is the market support here? How much traction have you accomplished to justify where you're at? And traction doesn't necessarily have to be revenue. It can be, pre-orders or whatever it might be. The team, if it's a founding team that's built and sold something before, I'd pay for you for that. And then what's the market opportunity that they're going for? I would say the first investment we made that was a device. And so far, it was a $10 million cap, but the opportunity to the business is billions of dollars. It's a huge opportunity. So that made sense. Or something I was comfortable with.
Angie, you can speak to how you had to deal with it early on. How did you get people to agree on a valuation, or what valuation did you pick?
We picked 2 million. We got the Texas investors. We're addressing a $20 billion opportunity. So when you look at stroke rehab, and we had a great team, and this is pre-IP. I mean, we hadn't even hired our team. We had a good business plan, and we had the right people in place. So it
it's hard. I mean, usually the person who gives you your term sheet is the one who's gonna be able to value, because we were so early that it was hard to, to do. And to tell you the truth, I didn't know what I was doing. So I was like, okay, starting to, I mean, I said, great, and for me, I wanted to get to work. And I was like, and sometimes you worry so much about the terms or like your equity or whatever. And sometimes, like, I remember coming to Rick with our term sheet, our first term sheet. He was like, a bird in the hand, Angie. And I was like, yeah, and that's true. It might have taken me 3 more months to be able to secure, or 6 or 9 or whoever. I wanted to, it was a race to the market. And so I accepted it. And I had other people say walk. But I accepted participating preferred shares from the get-go, and 2 million. And so, yep.
2 million, there you go. Rick?
It's a good point, bird in the hand. You don't know if you're gonna get another opportunity to raise money from whomever. Agree with what Jeff and Reid said, which is there's kind of a market. And so this phone call I was having yesterday, and the guy says it's 5 million, and I just tuned him out right there. And I said, hey, that's just out of the realm of normalcy. If it had been 1, 1.5, 2, 2.5, probably wouldn't even have dug into it right at that moment in time. So that gentleman was just not in the ballpark. And then I think the last thing is, again, the investors have to make money. And so if you realistic and say, all right, if we do this, a more realistic projection, and we value it 2 years from now, 3 years from now, 5 years from now, and then you discount it back, do the investors have a fair return? And so it's not just is a check relative to kind of what the world is now, but we heard it over here with Reid, big opportunities, willing to pay a little bit more. How he got there was he looked out in the future and then he brought it back. So I'd say it's checking it, sanity check for today, and then the future, kind of see if the numbers jive.
Other questions?
Question on managing expectations. So it's that you say to do something and then things didn't happen, and it's a bad news for the investors. So I'm in the enterprise business, software business, B2B, and my big clients move really slowly. It's hard for me to give. I don't want to give a really like later milestone dates, but I also don't want to raise expectations by even further. So what sorts of that how to manage that?
Is that question coming here or where? Well, I'll start since I'm the one who put that slide out there. I would err on the side of caution. Yes, if you say, hey, we're not going to do anything until 10 years out, you're not going to get funded. With that said, if you tell me you're going to close on $1 million order next week and that doesn't happen either, you're dead that way too. So people understand large clients are going to lead to long sales cycle. In fact, if you talk through that and show that you understand that dynamic, then now you're also demonstrating that you know your customer and understand the sales cycle. So I would be with you if you said, hey, big customers, long sales cycle, therefore things aren't going to happen until 2022. I'm with you. You tell me you're going to get a big customer next week, I'm like, no, that's not going to happen.
Yeah, I think putting it in context and being able to explain what are you learning along the way. So if you've had other interactions that have taken you this amount of time, but this is a new relationship, so we anticipate it taking around the same time. That just shows that you've been learning from your other and you can apply it to that. Now, if like somebody's like, okay, well, when do we actually anticipate this materializing? This is my best guess. The calculation you should have in your mind to answer the question is just like do 2 times as much of how long it's going to take, and then surprise us when it comes early. So you can play some games just by how you're framing it up too.
Thank you.
One thing I was gonna mention also is make sure that you have a good employment contract as you start this and you're taking on money. So I was married to, or I am married to an employment lawyer who practiced for 20 some years. And so I have one, but I've seen other people really get burned later on down. So make sure you before you start taking money that you have that. It's important.
Just a quick thing, so, Great Plant Moody, local law firm, created for us, a non-economic voting class of stock. And basically what we do at Co-Create X is we provide on a one-to-one basis for people who sign our either employment agreement or our, contracting agreement, a non-economic voting share for every stock option we provide. So the result is that for co-founders, that's really nice because you can keep earning stock options as you go, and you can keep earning voting shares as you go. It's a really great way to manage and continue to control your business.
That's an interesting, I've never heard of that, but I don't know if all VCs would agree. I don't know how they'd feel about it. So, but I think it's a great idea.
It was my own invention.
Great.
But ultimately it's been working well for us. And actually a lot of our investors really like it because they like the fact that we're not going to get to the end of the rope and not be able to keep going, right? We have a really big opportunity to centralize the social networking. And the fact that I keep showing up to work every day and working on it and keep raising more and more money to do it is ultimately encouraging to them.
Right.